Throughout the times, there had been some up and downs in the stock market. But in recent years, the market has risen to impressive heights. While for the unsuspecting majority, that's wonderful news, a sign that both the economy and their personal portfolios are thriving. For financial analysts and experts like Jan Eeckhout, however, the glorious boom of the stock market is rather a warning sign that there's something going wrong with the economy. Today, we'll be looking at what's making the stock market go up, why the booming stock market is bad for the economy, and what are the problems that could arise from the prosperity of the market. Let's take a look at just how well the stock market is currently doing.
Major indexes, the Nasdaq today up about 2.5%. Same for the S&P 500. We had the Dow up 2.2% and the Russell 2000 up 1.8% behind today's move. So getting in some investors out there perhaps excited with the Nasdaq.
Stocks have been rebounding since investors began shaking off fears of a recession. And while this sounds like a good occurrence, in the long term, it might be detrimental. Experts, including Jan Eeckhout, have said that the upward surge of the stock market is powered by exploding profits generated by increasingly powerful corporations. But what makes these profits dangerous is that they are eating into the income of the vast majority of workers in the economy and hurting the overall economy. The announcement by Fed Chairman Jerome Powell of the Federal Reserve's decision to increase interests by 0.75%, the largest rate hike since 1994, in their efforts to bring down inflation, has unsurprisingly prompted the S&P 500, which has been in a bear market for a while, to bounce back into the green. In fact, all three indexes, the Dow Jones Industrial Average, the Nasdaq Composite, and the S&P 500, have rebounded ever since the hike in interest rates. That's not all. These are speculations based on Powell's comments that the Fed could hike interest rates by another 0.50% or 0.75% in July. And this has kept investors salivating at another potential chance to rake in more profit. But lurking behind those surging profits and high stock prices of corporate America is a powerful force. Eeckhout recognizes this force to be one of the biggest reasons why the wages of typical American workers have been flatlining, and why the workforce percentage has seen a significant reduction. This force also explains why the share of national income going to workers has declined, and why startup growth has been sluggish in recent times. This mysterious force, according to Eeckhout, is none other than the starting growth of market power since 1980. Market power has resulted in the markups of publicly traded companies in the United States tripling since 1980. The companies with monopoly are much more profitable than before. In 1980, for example, the average profit rate of a publicly traded company was around 1 to 2% of sales. Currently, they now have profit rates of between 7 and 8% of sales. But it's not that the profits are bad per se. It's just that the excessive profits of so many companies are becoming detrimental to the economic livelihoods of simple workers. Because of market power, workers not only have to pay higher prices for goods and services, but they also find it harder to get good-paying jobs. When companies with market power hike up their prices, it inevitably results in low demand, and low demand means that the companies need less workers, which in turn results in a mass layoff or a reduction in demand. But how come market power has risen so much? There are two big factors we can blame for the rise of market power. The first is the fact that the government has not done much to prevent companies merging with and swallowing up other competitors. The second factor is the patent system, a system so generous that it grants very long monopoly right to companies to sell all sorts of gadgets and pills. These factors have fostered the disastrous monopolies we see today. Finding a solution to market power won't make stock traders and companies happy, but limiting market power and increasing competition would be beneficial in the long run to the economy. A return to the levels of healthy competition we saw in the early 1980s is the only way to increase spending, save jobs, and save the economy.